Wizz Air's latest result says the immediate shock is jet fuel, but the more important stock question is whether its growth model is making that shock worse. In the 3 months to June, passengers rose 25.1% to 21.2 million, and revenue increased 5.5% to 1.51 billion euros. Yet the airline swung from a $38.4 million profit to a $198.2 million net loss. The evidence supports a fuel-led hit amplified by capacity and fare pressure, but it does not yet prove whether this is a one-quarter shock or a lasting margin problem. Fuel expenditure rose 39.4% to 610.5 million euros, while the airline's operating loss reached 183.3 million euros. Wizz's exposure to Middle Eastern flying was described as limited, with aircraft moved towards Europe. That decision helped preserve the network, but it also put more seats into shorter, competitive routes. Capacity rose 25.4%. Load factor remained broadly steady at 90.9%, yet revenue per available seat kilometer fell 8.1%. Full planes were not enough. Wizz had to use lower fares to absorb the new supply.
That is the direct mechanism for shareholders. The conflict raises fuel costs, while rapid expansion weakens pricing. Revenue still grows, but each seat produces less revenue and the cost base moves faster. Wizz now has almost 300 routes less than a year old, compared with roughly 70 to 80 previously. Management says the aircraft must be deployed because the company is paying for them. That makes growth a continuing operating decision, not simply a response to temporary demand. A useful comparison comes from IAG's earlier results. Faced with the same fuel shock, British Airways owner moved towards flat capacity, saying it had recovered about 60% of the higher fuel bill through revenue and cost savings while maintaining its margin target. Wizz is taking the opposite risk, keeping capacity growth high in the hope that new routes mature and later produce better margins. This makes the issue less about whether people still want cheap flights and more about who absorbs the cost of supplying them. There is a more favorable reading. Wizz carried more passengers, has more than 2 billion euros of cash, and reported a strong liquidity position. Aircraft affected by Pratt & Whitney engine groundings are returning to service, with 27 grounded at the end of June compared with 41 a year earlier. Management expects the fleet disruption to end by the close of 2027, while new bases in Spain and Kosovo are intended to improve aircraft utilization and route maturity. That strong demand is not the same as strong economics. The same figures show that passenger growth has not yet protected yield. The company's own explanation includes new capacity, competitive pricing, altered booking patterns, and the Middle East disruption. The fuel shock may fade. The need to fill hundreds of young routes will not disappear immediately. For a holder, the useful metric is no longer passenger growth alone. The question is whether revenue per seat and operating margin recover as the new network matures. For a watcher, the loss should not automatically be read as a collapse in demand, but neither should the full aircraft and rising passenger count be treated as proof that scale is creating value. The next results offer a real checkpoint: whether the current quarter's planned capacity growth and the new winter routes produce the margin expansion management expects. If yields improve while capacity remains high, the loss will look mainly like a temporary fuel shock. If passengers continue rising, but revenue per seat and margins remain weak, today's result will look more like evidence that Wizz Air has expanded faster than its economics can absorb. The current evidence supports the first concern, but does not yet settle the second.